Good morning. Today is Wednesday, August 26, 2020, and thank you for joining us for another edition of the Market Commentators. My name is Andy Wilms. I am President and CEO of the Milwaukee Company, and joining me as always is Mike Wilms, who is the Milwaukee Company's Chief Operating Officer and Compliance Officer. And just a quick reminder that nothing in this podcast should be construed as investment advice, and the views expressed represent Mike and my personal opinions and not necessarily those of the Milwaukee Company. Good morning, Mike.
Morning, Andy. Morning, everyone.
I think we'll get started right into the market recap this morning because we have a lot to cover. So I will say that Wall Street was a mixed bag last week. Both the S&P and the NASDAQ were up on riding the backs of the mega cap stocks, nothing new there, while the Dow and Industrial Average and the Russell 2000 small cap index both finished the week lower. The stock market continued to march higher on Monday, driven by, I'd say, a combination of optimism around the coronavirus, which you'll be filling us in a moment, I know, Mike, and as well as some additional gains in the tech giants, which just keep moving higher. Yesterday, Tuesday, the S&P closed at a record high, but it's important to recognize that only 38% of the S&P 500 stocks are up since February 19th, which is the date the index last reached its previous record before the virus struck. And it's this lopsided market action that we've talked about a number of times, Mike, that has some market participants concerned about the sustainability of the rally. And I just point out, that all of these record highs really can't erase all of the risks of the economy, the biggest of which, of course, is the biggest health emergency in 100 years. But that being said, the rebound in equities and the support of bonds by lowering these risks in investor portfolios does demonstrate, I think, a willingness, or I should say an importance of keeping a long-term view on your overall investment portfolio and how you're going to manage your investments. We can't get carried away too much with what's happening at any given moment. We have to keep the long view in perspective. And with all of that being said, Mike, why don't you update us a little bit what's going on with COVID-19?
Well, there's been some positive developments. The overall infection rate has dropped almost 50% from the peak over the last 7 days on average. And thankfully, the death rate has also dropped fairly dramatically, below 1,000 patients per day. So those are huge positives. The development of vaccines continued to speed along. The two largest phase 3 clinical trials, the Moderna and Pfizer sponsored trials, have enrolled over 25,000 patients in total between the two trials. The effective rate for developing antibodies against the virus has been higher than originally expected at the 70 to 80% level. And if you remember back when we talked about this once before, the FDA was hoping for 50% effectiveness to approve a vaccine on an early basis. So that's all pretty amazing. And I think you had something to share about the fishing, the results on the fishing boat, and potential for mixed signals on reinfection versus not.
Yeah, there was kind of conflicting news about this whole thing. If the idea is that if you get the coronavirus once, you should develop an immune ability to your internal immune system should be able to fight it off from future infections, at least for a period of time. And on the good news, there was a study of a fishing vessel carrying 122 crew members, and there was an outbreak on the ship, so they returned back to Seattle, and more than 100 of the 122 sailors tested positive, but the 3 who had antibodies at the start of the trip did not retest positive. So that's a statistically almost impossible to occur if they hadn't developed some immunity. But at the same time, there have been 3 confirmed cases of reinfection in persons who have recovered from the virus. But this isn't, necessarily anything to be overly concerned about, because all respiratory viruses, including the common cold and influenza, you have one bout. That doesn't mean you're going to necessarily be completely immune from it. It just means that your reaction to a further infection could be much more mild the second time around. So all in all, I think it's quite positive. Did you hear any? Are you up to date, Mike, on what the Food and Drug Administration has been doing with this blood plasma? Have you heard about that?
I'm almost hesitant to talk about the plasma situation, because the news stories are so conflicting. They had Scott Gottlieb, the former FDA chairman, on CNBC this morning, and he kind of begged off the question also. He thinks that the FDA made the right decisions on the convalescent plasma, that the data is there to support the emergency use authorization, and there is a number of patients that have an effective positive response through use of the plasma, and you'd want to use it with the patients that are high risk. It's not for a general application to fight the virus, but it's been politicized, and it's kind of difficult to understand or know what's true and what's not.
I've read a little bit about this. I saw Dr. Gottlieb also, and I think what he was trying to say is that this is a good stopgap until we have more effective treatments. We know there's a good chance that this could work, so its approval was good. The thing that is creating all the political buzz is that there hasn't been much testing of it. There haven't been a lot of clinical trials with control groups, because nobody who's infected wants to take a placebo. And of course, in order to have a control group, you got to have people willing to know that they have a 50-50 shot of getting a placebo, which is made difficult to get clinical trials. But, the science is there for it should be working. But, I guess you're right. Both sides have politicized this to the point where it gets really difficult to know how helpful it could be. But I think it's a positive in my mind that the FDA did come out and approve this for use in emergency type situations.
Well, it's kind of interesting. I mean, with Dr. Gottlieb being on a couple of boards, he's on Pfizer's board. He's very reticent about commenting about the what would be considered inside information.
Right.
The things that he's made aware of as a member of Pfizer's board. He was aware of the Pfizer announcement about the progress on their vaccine. The board had been briefed before the news story came out. But based on the data that Dr. Gottlieb had seen, if he was still the head of the FDA, he would have sought approval himself.
Right. But it's unfortunate.
That's a pretty good validation.
Right. In a presidential election year, you can hardly not expect this to get politicized. I mean, you have the one side saying, "Oh, we got look what we do. We've got something that's really effective. Hey, hooray!" And then you have the other side say, "Wait a minute. This might be no good at all." And you're getting way ahead of getting over your skis. And probably the truth, as usually is, falls somewhere in the middle. But overall, I think it's a positive thing. Well, let's switch to a less political subject, and talk about the economy, because there it's just the facts, that we're going to talk about. And I guess you would have to say that the economic data continue to show the economy is recovering from the virus of recession. In data released last week include strong, better than expected housing starts, more building permits, and existing home sales, all being better than people had thought. And I think the recent data, I think, does give reason for optimism on the state of the economy. There are still a lot of threats that remain that could deliver a significant setback. And I think the Federal Reserve in its announcement said, and I'm just going to quote them, so excuse me for reading, but the ongoing public health crisis would weigh heavily on economic activity, employment, and inflation in the near term, and was posing considerable risks to the economic outlook over the medium term. And I think that's a pretty fair assessment of where we're at. And I think the biggest threat is the unemployment. And just I'll just say real quickly there that the weekly initial jobless claims rose by 135 for the week ending August 15th to a seasonally adjusted 1.1 million. And that increase follows 2 weeks of declines, but at the same time, the number of people continuing to collect unemployment benefits fell to about 14.8 million for the week ended August 8th. That's the lowest number since start of April, but it's still a very, very high number. So, Mike, what's your take on all this?
Well, I mean, the durable goods orders numbers that came out today, and that would be, purchase of automobiles and manufacturing equipment and airplanes.
Yeah.
They had been expecting an increase of 4.3% after being up 7.6% in June, and the number actually came out at 11.6%. So, and that's the slowest part of the economy to come back is durable goods. So that's a positive, and that would lead you to believe manufacturing is starting to pick up. And that helps with unemployment and so on and so forth. So, it's the green shoots kind of thing. It's really hard to tell where we are, but some of the economic data really seems to be indicating that we're getting some traction to recovery.
Yep, I agree. And that's all for the good. So with that said, then let's start our discussion about the way the stock market. We've talked a number of times that since the market has recovered to such an extent, so many all-time highs in the major indexes that many investors are starting to wonder if the markets are acting irrationally. So I'm wondering, given the uncertainty around the COVID-19, the record unemployment, the declines in second quarter GDP, do you think that it's irrational for the markets to reach all-time highs?
Well, I mean, we all know that the market is forward-looking, and yes, you had an all-time, the largest decline in GDP in the second quarter, but they're forecasting the largest GDP increase in the third quarter. So with a forward-looking market, and if you look at some of the market darlings in here, the big tech companies, some of the financial fintech companies that are direct beneficiaries to everything migrating to online transactions, banking, retail purchases, you name it. Their potential market share gains, their earnings gains, in a forward-looking mechanism, that all would seem to make sense to me.
Okay.
And then I think everybody needs to keep in mind, everybody talks about the Fed, but not about some of the specifics with the $80 billion of treasuries that they're still buying every month, along with $40 billion worth of mortgage-backed securities. They're still providing a huge amount of tailwind to risk assets, whether it's the equity markets or any other type of asset.
Well, I agree with all of that, and I'd also point out that from a mathematical point of view, you can make an argument that the market's priced exactly right. And the reason I say that is because the returns on bonds and other low-risk assets have dropped so low, and the Fed Reserve has cut its policy rate to about zero. What that means is that the required return for stocks to remain competitive has plummeted dramatically. So as the required return on your investment drops, the simple math tells us that the price of stocks should go up, right? As the required rate of return decreases. Now, that being said, if interest rates were to rise, for example, because the dollar weakens or continues to weaken, or deficits get too large, or inflation returns, then the required rate of return for equities would have to go up because interest rates would go up. And so the required return on equities would have to go up to remain competitive, at which point you would expect stock prices to fall. So where we are now seems to make sense, but that does not mean that we haven't moved up the risk curve on equities. I think clearly we have. That would be my take on that. And we know, we talked about how the indexes have done so well and the markets have gotten so high as looked at by the indexes. But as I mentioned earlier, it's really concentrated in the so-called FANMIG stocks, Fidelity, Apple, Amazon, Netflix, Microsoft, and Google. It's kind of concentrated in those names. And we've talked in the past how they've gotten such a disproportionate influence on the market weight indexes. For example, the 10 largest stocks in the S&P now account for 28% of the index capitalization. That makes the benchmark the most top-heavy index since the 1960s. So I guess this leads us to a question, how concerned should we be about this concentration of returns in the S&P and the NASDAQ in particular?
Well, I think you make an interesting point talking about those large cap large cap tech stocks. But if you compare their forward earnings per share estimates to Visa or MasterCard, household names that we all know and use, the credit card companies' multiples are higher than Google and Amazon and those big cap stocks, and it's all a function of what your growth perceptions are.
Right.
I think it's a great point. If you look at historical relationships, people think about the earnings yield on the S&P 500, which is the annualized earnings forecast divided by the value of the index, and you compare that to the 10-year Treasury, and you would say the stock market is dirt cheap.
Right. Exactly. And I've said before, concerned about the concentration of the return in these mega cap tech stocks, and whether that bodes problems in the future depends, because it's kind of like been a winner take all situation with the coronavirus, right? If you're in tech and you can profit from the stay at home orders and that type of thing, then you've done really, really well. And when those drop off and the conditions improve, it would seem that these mega cap tech stocks will grow a little more slowly, and their growth in their stock prices will slow or perhaps reverse. But there's 490 other names in the S&P 500, which many of those will benefit from things going back to more normal. So it'll really depend on whether the other, if the top 10 names start to suffer, if the other 490 names will do well enough to keep the index from falling precipitously. And I don't think anybody knows the answer to that. So it does make sense to me to probably look at some more equal weighted ETF, because if we're thinking the other 490 will do better as the coronavirus threat is reduced, then an equal weighted ETF will probably provide you a better return going forward than the market weighted indexes have. Certainly the market weighted.
I think that's a great observation. If 38% of the S&P companies are up and the other 62% are down, if the value side of the index components starts carrying the water, moving higher, that equal weight vehicle is going to be a star performer.
I think that's definitely a potential, and there's no point. Maybe it's a good idea to balance a little bit rather than being in all one or the other. Up in this point, market weight was the way to go, right? Up to this point, but now if you're 100% in market weighted indexes, it may make some sense to start looking at, adding some, rebalancing or rotating into some equal weight.
So equal weight, exactly.
Let's talk about what's going to happen on Thursday, because we'll be a little forward looking ourselves. And we know that Fed Chairman Powell, Fed Chairman Jerome Powell, let me say that again, is going to be giving a major announcement. He says it's going to be a big deal. Everybody
consequential.
Consequential. Yeah, well, that's fancy for big deal in my book. But and I think the cat's pretty much out of the bag that the Fed's going to be adopting average inflation targeting, which is basically we'll let the inflation rate run above the 2% targeted rate if it's spent a considerable amount of time below that, like it has now, which will allow the Fed to pay less attention to inflation and keep the stimulus running longer than it could if it was worried about capping inflation. So my question to you is, such a major policy change warranted at this time, given that what we've talked about, that there's a considerable progress on the virus, the economy seems to recover, the market's been doing very well. So is this a good time to be doing this kind of thing in your mind?
I mean, we're trying to avoid repeating a bad playbook.
Right.
So everybody, we're in a bad place here. We've got the financial regression. People aren't earning anything on their savings. With interest rates at 0 to 25 basis points, right. The Fed would
Pensions
like to
can't make their required rates of return. Insurance companies are in trouble. Banks are in trouble.
The Fed would like to see interest rates higher because it gives them more tools in the event that when the next recession would come down the pike.
That's what my biggest concern is as well, with these super low interest rates. So this idea of, I think the idea of using an average inflation target or average inflation rate targeting makes a lot of sense conceptually, but I do worry about keeping the rates so low for so long. But there's a huge incentive to do it, right? When you've got the trillions of dollars on the deficit, letting interest rates go up would be very, very bad for the budget. So there's no easy answer to this one. And
a lot of moving parts.
A lot of moving parts, but I think there's arguments both pro and con as usual. But I think overall it's probably a good idea at this point in time not to be so focused on keeping inflation at 2%. I think we can allow it to go a little higher right now.
So what that means is that the Fed would be on the sidelines in terms of interest rate increases for some period of time as the economy was steaming along and growth was to the point where you were starting to see inflationary pressures.
Right.
So,
right.
You'd start thinking about, where are the 10-year interest rate, where would you expect it to be? Those are interesting questions.
Absolutely. Okay, so with that said, I think we have time for just one more question. So I'm gonna jump right into one last market question, and it really basically, everybody seems to be a bull right now, right? Everybody's betting on the market to recover. It seems, when you watch Squawk Box and
be careful. The market has recovered. It would be going higher.
Well, higher. Okay, the market to continue to move higher. There doesn't seem to be many bears out there anymore. The S&P's up 52% in 5 months, and I noticed that there has been a 1% drop in the market in 23 trading days, which is the longest stretch since January. And perhaps the greatest indication that the bears are all apparently hibernating is the short positions of hedge funds, which is the lowest in 16 years. So do you have any idea where all these we typically have a pretty good balance between bulls and bears, and now that balance seems to be out of alignment. What's your thoughts about that?
Well, I think it's two things. I mean, and both are behavioral, psychological kind of considerations. It's the fear of missing out, FOMO. If you're a professional money manager and you've got cash on the sidelines and the market continues to move higher, you can't sit on the sidelines. You need to participate. Going back to your comments about historically low interest rates, with the 10-year Treasury at 71 basis points, there is no other alternative to
Game in
stocks.
town. Yep.
So you got the TINA and the FOMO.
All working together, huh?
Yeah.
This whole situation kind of reminds me of one of Warren Buffett's most famous quotes when he advised investors to be fearful when others are greedy and greedy when others are fearful. So if you adopt that present mind right now, it's probably a time to be a little fearful because you certainly don't have a shortage of greedy people in the market. And we also have a situation with the millennials, who have been really instrumental, I think, in driving the stock prices higher. They've played a major role, and I'm happy to see. I think it's a wonderful thing that so many millennials are finding themselves into the markets, but many of them have little experience with a major market correction, and you can't help but wonder what's going to happen when the first push on Tesla to go down, really faces are people going to be bailing out like crazy because they don't want to fear of missing out on the downside as well as the upside? I mean, that to me could happen. So I guess you could call me old fashioned, but I don't think it's a good time to discount the possibility of the market reversing course. I think I would keep that in my thinking as I manage my personal investment portfolio. Okay, with all that being said, Mike, I'm afraid our time has once again come to an end. So I am sorry to say I'm going to have to close out our discussion for this morning. But I want to thank all our viewers and listeners for joining. We greatly appreciate it. And be sure to tell your family and friends about our podcast if you think they might enjoy it as well. And please keep in mind that you should not act on anything you've heard in this podcast until you've discussed it with a qualified personal financial planner who is familiar with your individual situation and your personal investment objectives. So with that, I will tell everybody good day, and we will see you next week.
This podcast is for general informational purposes only and is not intended to be a solicitation, offering, or recommendation of any security, commodity, derivative, investment management service, or advisory service. Nothing in this podcast constitutes or should be understood as constituting a recommendation to enter in any securities transactions or to engage in any of the investment strategies discussed. Viewers should consult with an independent financial professional or independently research and verify information presented in this podcast before acting on it.